This is the current federal tax developments for the week of December the 10th, 2018. Current federal tax developments are brought to you each week by Kaplan Professional Education and by your state society of CPAs. I'm Ed Zollers, and we'll be talking this week about some of the things that have happened in the area of taxes this week. One of the things we'll start out with, we're going to look at the fact that we've got the states working on workarounds again. This time the state of Wisconsin passed a workaround for the SALT limits. We have guidance coming out on the Section 81 election to defer recognition of income related to certain stock grants. We have information. We also have a case this week where a taxpayer finds that despite the fact they're no longer listed property, you still have to have some sort of documentation to claim a cellular telephone expense. That's a business expense. The IRS failed in court to persuade the court that the taxpayer had changed its accounting method. We have a brief revisit to what we discussed last week, 451B's automatic change revenue procedure. Want to kind of clarify how that works in combination with an earlier revenue procedure that came out. And finally, we have a taxpayer who was warned about filing tax court petitions primarily to delay collections, and the warning that the taxpayer would be penalized in the future if they kept doing this. Let's start with the states going back again and trying to get around the $10,000 cap on state and local taxes. This is Wisconsin Assembly Bill 1069, Senate Bill 883. It was passed finally on December the 5th. It is awaiting signature of the governor. Now, this bill has a lot of things in it. And some of you have been reading about for other purposes on the news, and we're not going to talk about any of that stuff because that's not relevant for us from a tax standpoint. But it has one interesting tax-related provision buried in it. This particular bill will allow a pass-through entity to optionally elect to be treated for Wisconsin state purposes as if it was a C corporation and pay a 7.9% tax. Now, that tax is higher than the maximum tax rate that would apply on an individual's return, but it's not that much higher. And of course, the theory of this is that by taking it this way, the taxpayers would be able to claim a deduction on the federal return because this would be a pass-through tax, as opposed to having to have it capped at $10,000. So if an entity elects to go this route, the entity itself would pay a 7.9% tax. The state of Wisconsin would take that money. They'd get extra money out of the deal. On the federal return, the theory would be that would be part of what's passed through as the total income from the S corporation or the partnership, and therefore, the offset would take place above the line. Again, we'll see what happens here. This is kind of taking the idea that Connecticut had and taking it a step further. In essence, moving it away from trying to give a credit to people for a tax paid at the entity level, but rather just take the income off the return, because again, this will be treated as if it was a C corp. That means for Wisconsin purposes, it wouldn't be taxed on the Wisconsin return, which means that for practical purposes, you don't need the credit anymore. In some ways, if you're going to do an entity level tax, this seems to be a little more, shall we say, a little easier to handle structure than what Connecticut has. But we'll have to see whether the federal government considers this to be yet another one of those things they need to try to shut down, or whether they'll consider this acceptable. The flip side, of course, is if this is acceptable, don't be surprised to see most states come forward and offer this option for pass-through entities. In essence, yeah, guys, you could be taxed as a corporation, and if you do that, we'll go ahead and remove your income from basically from our state returns. So, hey, should be fine. We'll have to watch this. It's getting interesting. There's another bill that's being drafted, tax analysts reported, by legislators in the state of Arkansas in this area. So apparently this entity level pass-through deal is beginning to pick up a bit of steam, and we'll just have to see what works, if any. Now let's go to the federal cases this week. We have a few issues coming up. The first one here is going to be Notice 2018-97. It was issued on December the 7th of 2018. This particular notice talks about a provision in the Tax Cuts and Jobs Act, Section 83I. Section 83I allows, if you're qualified, if you get a grant of stock, restricted stock units, you are able to effectively defer recognition for 5 years. If it's a non-public company, the stock's not tradable right away. Various other issues, but we can have up to a 5-year deferral of income on this issue. Now, the notice deals with 3 major areas, and actually 2 of them overlap in the way they handle it. The first thing they look at, though, is there is a rule that in order for this to happen, you have to basically, grants must be made not to less than 80% of all employees who provide services to the corporation in the United States. A lot of commentators wondered, well, is that 80% test based on cumulative offers? So let's say, when somebody comes in, or they're here for 2 years, they're here for a year, whatever, we offer them stock, or do we have to meet the 80% test each year? The IRS said, based on the way the law is written, the law appears to require the 80% test to be met each year. Obviously, that's going to make it a little more difficult to structure such programs, since companies may not want to grant stock to what's effectively everybody, or pretty close to everybody, in order for this program to come into play. The second question took a look at what's going to happen with withholding taxes. And the IRS said, well, FICA and FUTA withholding is not changed in this situation. So regardless of this 5-year deferral, if in fact the FICA and FUTA tax would be due today, basically it's owed when it was owed in current law. But they said federal withholding tax will be delayed under this 5-year deferral rule. And because of that, they said, well, in order to protect us on that, what we're going to end up doing is putting together a special escrow arrangement that has to be used by the employee and the employer for this stock to help assure us that we're going to be paid the withholding. Now, that's the stated reason for it, but the real issue was a little different. A lot of employers were concerned. What if I offer stock to my employees? Maybe I do offer stock to 80% of my employees, or offer stock to everybody this year. Do I have to follow these rules, which is going to be a little more complicated for the employer to trace? Or, in essence, is there any way for me to get out of this? And the law itself seemed to suggest if you met the requirements, there was no way out. But by the IRS having put this special escrow account in here, they make it very clear that if the employer simply doesn't set up the escrow arrangement or agree to an escrow arrangement, that the stock won't qualify, no election could be made. This is interesting. Again, doesn't appear, and there's not been a lot of talk about people really wanting to do this, more people wanting to avoid it. So we'll see if anything happens. But if you were interested in this as an option to offer employees, now you do have some guidance on how to do it. Otherwise, we're going to kind of be waiting to see how this goes. Next up, we're going to take a case here, the case of Archuleta versus Commissioner, Tax Court Summary Opinion 2018-55. The opinion was issued on December the 3rd. You may remember that beginning in 2010, cell phones were no longer listed property. Listed property is property that a taxpayer cannot claim a deduction for having, a deduction for business-related expenses related to that property unless the taxpayer had maintained contemporaneous documentation in accordance with the requirements section 274D. With cell phones, that generally meant that I had to have a record of business and non-business calls maintained at the time that those calls were made. I had to break down my expenses based on that, and I had to have other types of information ready for the IRS should they come to question it. Well, 2010, it was removed from the list. Congress finally decided it wasn't really worth the bother. It's gone. But does that mean carte blanche? It does mean that, in theory, the Cohen defense is back on the table for these phones. But that doesn't mean that you don't have to have any records. In this particular case, a taxpayer had a cell phone from AT&T, but the cell phone was on a family plan for the taxpayer's spouse, the taxpayer's child. The taxpayer had no records of how much of the use of that entire plan, they had the entire cost of the plan for the year, how much of that plan represented the taxpayer's use of phones for business versus the portion that would be more representative of the use of let's say, the taxpayer personally for the phone and the taxpayer's spouse and daughter, who obviously would not have business use of the phone for this business. He also didn't have records of the actual payments of the bills from AT&T. The tax court made it clear, absent that information, he could not get a deduction. While we no longer have the mandatory requirement of specific documentation, even under the Cohen defense, there has to be a rational basis upon which to estimate the amount of expense incurred. In this case, because he didn't have anything, there was no rational basis upon which to estimate how much of that cell phone bill should have been taken on his business. Therefore, the court held none of it was allowed on his business. Next case. This case will be an IRS loss. Thrashes Inc. versus Commissioner. Tax Court Memorandum Decision 2018-199 issued on December the 4th. In this case, the issue relates to a method a taxpayer was using for advance payments. Now, that has actually now been incorporated into the code at 451. We'll talk about 451 in general and other issues a little bit later. But effectively, a taxpayer who used the rules under the old 2004 revenue procedure recognized income on advance payments. The advance payments you got this year. You recognized income at least as quickly as you recognized it on your GAAP financial, your Apple financial statement. And then you had to pick up the rest of the income in the following year. There was no doubt that this taxpayer had, in the early 2000s, actually used this on various transactions, the advance payment system. Now, in this case, there was a particular contract they were working on, and the outside auditor found a potential violation of the agreement. The auditor felt that because of that, conceivably, Thrashes might have to refund that money. So the auditor said, no, this is a deposit, not an advance payment. And so we're not going to pick up income on it using those rules. Rather, we're going to go ahead and set this up as a deposit. The following year, the issue was resolved. That year, Thrashes picked it up as an advance payment and used the advance payment test in year 2. In year 3, obviously, the rest of the revenue got picked up. Now, the IRS said, wait. We believe that that represents actually a change in method. The taxpayer agreed later that the auditor had been in error, that this should still have been treated as an advance payment, both for GAAP and for tax purposes. They conceded that. But they're saying this did not represent a change in method. If it was a change in method, what the service wanted to say was they had changed their accounting method. Because they had changed their method, the IRS was within its rights now to switch the taxpayer to a method that, in the service's view, clearly reflected income. The method the IRS would have switched them to was a method of fully recognizing advance payments. That is the second option under the revenue procedure. You can recognize advance payments when received. That obviously would have caused a lot more tax to be due a lot earlier. The taxpayer said no, it should have been an advance payment for, in this case, 2008. The rest of the revenue, the rest of that $15 million should have been picked up in 2009. And 2010, was not the year to release the revenue. So our real question is, do we pick it up in 8 or 9 was the question here. And obviously for penalties and other issues, it can make a huge difference which year it's picked up in. The tax court didn't really agree with the IRS. The tax court pointed out, you have to know some things about an accounting method. And especially the difference between accounting method issue and correction of an error. The tax court said, important thing about accounting method is it has to be applied consistently. The tax court noted that there was no other transaction like this. This was a standalone special transaction. Okay. They said, so we don't have a consistent application here. That would be along with lines of being fine to view this as an error. As well, the tax court noted you do not change your method of accounting for things if you have a significantly different fact pattern for the transaction in question. The tax court noted that this particular fact pattern was very different. And third, the tax court said, it looks like an error. The auditor had a legitimate reason to believe that this possibly should be treated differently. There may have been an error, but they went forward in good faith on that issue. Now, the court didn't really say we don't have an accounting method issue here because the IRS was moving for summary judgment. But they rather said that there are issues of facts to look at in each of those areas that have to be looked at before we decide that this represents a change in accounting method if the IRS is right about that. So the court did not grant the IRS a summary judgment. Therefore, this particular issue where they actually had this one transaction where they had basically held the $15 million for 2 years instead of one, the court found that did not represent a change in accounting method. Rather, as noted, it was a different circumstance, and it probably was an error, and errors are not accounting methods. Next case up, we're going to go back and review our automatic change revenue procedure that we discussed last week. That was Rev Proc 2018-60 that was issued on November 28th. You may remember this. This is the one for that revenue conformity rule under Section 451B added by the Tax Cuts and Jobs Act. I thought maybe I should review it a little bit because I had some time to go through it. And I thought I'd try to explain the differences here. We talked about the basics last week. I just want to talk about this issue of what if you have ASC 606, right? That's the Accounting Standards Codification 606, that people issuing GAAP financials, and the vast majority of people who are going to have an AFS are going to be doing a GAAP financial compliant with ASC 606. You may want to use ASC 606 methods for tax purposes. And the IRS had issued a previous Rev Proc 2018-29 that allowed you to apply for that. It did not say that the IRS would automatically would basically grant you that your that your ASC 606 way of recording revenue would be okay for tax, but they did say if it was okay, then you could get automatic permission. This later revenue procedure is only to be used for what I'll call one-sided conformity. That is, 451B says the all events test is met either at the time it would otherwise be met under the law, under the standard rules, or if earlier on the date that revenue from the transaction is recognized in the AFS. That's one-sided, because if in fact, the standard way you've been doing to recognize revenue, had the revenue recognized earlier for tax than for GAAP, well, in that case, we're still going to do it the way we did before. The all events test was met earlier under the way we had viewed it before. We couldn't go back and use ASC 606. What if a taxpayer really wants to switch over for consistency to using ASC 606 methods, which may, in many cases, be able to be defended as meeting all the requirements of federal law? Well, if you want to use ASC 606 both when it accelerates revenue faster than what you're doing currently and when it slows down revenue versus what you're doing currently, that's when you have to use Revenue Procedure 2018-29. And under that revenue procedure, take and make your change of accounting method. That Rev Proc will require a Form 3115. So that'll have to be filed with this. So if you're going to go down that path and you want to go to ASC 606 as your method of reporting revenue, then you are going to file 3115. You can't use the no 3115 rule that was provided in this Revenue Proc 2018-60. That only works if you're willing to live with the one-sided issue, where we just have to worry about picking up revenue that comes in faster. If you want to truly go to 606, you need to file the new Rev Proc 2018-29. That's going to create some interesting decisions to be made, both this year potentially for public companies, but probably next year for most non-public companies, because next year is the year in which they're going to have to start using ASC 606. What I think may happen in a lot of cases for a private company, you'll use the automatic no 3115 method this year. Next year, the year you actually adopt 606, you'll take advantage of Revenue Proc 2018-29 to make the change there to go to full conformity with what will now be your 606 rules, because the first you'll be under 605. And when you go to full conformity with the 606 rules, then you'll need a Form 3115. Finally, this week, we're going to take a look at a case of the Community Law Firm, Inc. versus Commissioner, Tax Court Memorandum Decision 2018-198. The community law firm had a payroll tax problem, right? And the IRS had sent them notice that they were going to levy based on these payroll taxes that were unpaid. Okay, the taxpayer filed for a collection due process hearing related to this issue. When the appellate conferee took a look, or I should say settlement officer is the term we use here, when the settlement officer in question took a look at the case, they discovered that In fact, these guys had not filed 941s for periods after the period that was the subject of this proposed levy. That's problem one. Problem two was that they had violated their installment agreement. Now, all what they asked for the CDP was saying, look, there were collection alternatives available. They wanted to reinstate that installment agreement, but they provided no financial data. And when the settlement officer said, hey guys, you got to send me the financial data, and the settlement officer set up a date for the phone conference. The taxpayer did not provide the financial state data, and they missed the phone conference. They didn't call in at all. Okay, the agent contacted them again, told them again, I need the financial data. They did set up a second phone conference, but all that happened there, no financial data came in. Again, the taxpayer said, just restore our installment agreement. The IRS settlement officer turned down that offer, said, sorry guys, that's not good enough, and went ahead and said we could go ahead with the levy. The taxpayers filed in the tax court. The tax court looked at this structure and said, guys, the IRS is within its rights in this area. Why? Because the IRS, first, you did not provide the financial data. It's up to the IRS. This is a discretionary move for part of the IRS to waive collection and to allow you to do something else. They said, so it's not mandatory. And in that case, the IRS has the right to ask for reasonable items to come to their decision. And one of the key reasonable items to come to the decision about whether you should be allowed to pay over time is what your financial situation looks like. Are you sitting on more than enough cash at this point to pay this off? And if you are, then probably it doesn't make sense to allow you to, delay payment. You didn't provide that. So there's another independent problem. The IRS would be totally within its rights to deny you an installment agreement when you're not being compliant in later years and you're not fixing that problem. So the tax court said, look, there's no reason to find that the IRS settlement officer had acted capriciously or arbitrarily in this case. Rather, the IRS settlement officer was fully justified in coming to the decision that she came to. The tax court noted as well, though, that this particular taxpayer had a very similar case before the tax court previously on the payroll tax issue, and with a similar set of results. No real cooperation. They just asserted they wanted this installment agreement, never gave the information, lost therefore at the settlement officer level, filed in a tax court. Eventually the tax court came back and said, sorry guys, you have to pay. The tax court said, look, what we're coming to a conclusion at this point is that you're filing these tax court petitions mainly to delay the time when you have to pay, because the tax court petition, remember, you don't pay the tax due until such time as the tax court has heard the case. The tax court warned the taxpayer that if they kept this up, they could be subject to a $25,000 penalty for filing a frivolous case before the tax court. They warned them, essentially, we don't want to see you back here a third time. And, given the fact they haven't filed the 941s for later quarters, seems highly likely they will again have the same problem arise. Interesting issue. And again, one of those cases, this is one for abuse of process. Yes, the tax court's not thrilled with abuse of process. Well, we're getting here toward the end of December, right? Things are coming up, and we're starting to get to the end of the State CPA Society course season. Now, I still have things happening this week. Monday and Tuesday, I will be in Bloomington, Minnesota. Monday for financial estate and tax planning for those over age 55. That'll talk about some estate planning issues. That'll talk about some retirement plan issues, Social Security, that kind of background. The second course I'm going to teach this week, though, will be the qualified business income taxes and more, the basically 199 Cap A issues and other issues from the Tax Cuts and Jobs Act that impact businesses. That will be on Tuesday, again, at the Minnesota Society offices in Bloomington. On Friday, I will be speaking on 199 Cap A. It seems to be the favorite topic for everything. At the New Mexico Tax Conference, along with a bunch of other speakers that they'll be speaking on other topics. So if you're in Albuquerque and you haven't signed up for that, take a look, sign up for that. The following week, I'll be back in Phoenix doing Arizona Tax Update, Arizona Ethics one day, and then I will close out basically for this calendar year. I'll be right back on it when the new calendar year starts, because again, there's still one more month of CPE season left after that date that I have to worry about, but there I do a lot more courses inside firms. But that will finish me up with current federal tax developments. Current federal tax developments is your last chance this year to get from me the issues on the 199 Cap A. That will be a major topic, current federal tax developments this year. So we'll be covering 199 Cap A and other issues in the Tax Cuts and Jobs Act. That actually be the major set of issues in there. It's kind of backwards this year. Usually we cover, the law changes in the past year in the first hour or so, and then we have cases and everything for the rest of the time. This year, very minor number of cases work because all developments have been the new law and then the regs and notices and other issues that come out of the new law. But I will be giving that as well in the following week on the 18th. After that, I'm basically done until sometime early in 2019 when I believe I pick up again in Portland, Oregon, doing some courses there. So you want to sign up, go check. We're running out of time. You really should get something on 199 Cap A before the end of the year. That's radically different. It's kind of helpful to know how it works. This has been the current federal tax developments for the week of December the 10th. You can catch my regular updates online, currentfederaltaxdevelopments.com. I hope to be able to get things up there more often. This week, I actually had time flying back to get a lot of updates written, so we got a lot more stuff online this week. The advantage there is I got the exit row, so yeah, that's why it worked well. If you have any questions or comments, you can send them to me, edzollers at currentfederaltaxdevelopments.com. You can also follow me on Twitter. My handle there is @edzollers. I follow discussion groups all over the internet. That includes at Reddit, where you can find me in the group that is /r/taxpros. I follow on state society discussion groups. That includes the Connect groups for the states of Minnesota, Arizona, New Jersey, not New Mexico, New Jersey, as well as Cal CPA's online board. It's called Tax Talk. We take a look at things in there, and I'll comment if I see something of interest in those areas. Well, take care this week. It's winter. And by the way, if you're having fun with Storm Diego, yeah, it was kind of interesting. I landed back in Phoenix in time to watch it come through here. Here it was just mainly a little bit of wet. Much worse other parts of the country, supposed to be. So hopefully all that works out. Look forward to seeing those of you up in Minnesota and in New Mexico this week. And otherwise, stay tuned. We'll see what we get this week in terms of new guidance. If we get something that's earth-shattering, like the final raise of 199 Cap A, obviously we'll be talking about that next week, as well as whatever else comes up. So join us back here next week for current federal tax developments.